Imagine two people. Same city. Same year. Same salary. One retires a millionaire. The other dies broke. Same income. Same opportunities. Different outcomes. What separated them wasn't intelligence. It wasn't even hard work. It was their psychology around money. And today, we're going deep inside one of the most important books ever written about financial behavior, The Psychology of Money by Morgan Housel. This is not a get-rich-quick video. This is about understanding why smart people make terrible financial decisions and how you can avoid being one of them. Most personal finance books treat money like a math problem. Budget more. Invest early. Diversify your portfolio. But here's the thing, we already know what we should do with money. We know we should save. We know we shouldn't overspend. We know compounding works. And yet, millions of intelligent, educated, hardworking people still make catastrophic financial decisions every single day. But Morgan Housel's answer is both simple and profound, because financial success is not a hard science. It's a soft skill. And that soft skill is dominated by your behavior, your emotions, your psychology, not your IQ. Doing well with money has a little to do with how smart you are, and a lot to do with how you behave. And behavior is hard to teach, even to really smart people. That quote alone is worth the price of the book. And over the next few minutes, we're going to unpack every single idea in this masterpiece, with real stories, deep analysis, and life-changing takeaways. So buckle up. Let's start with the man who wrote it. Morgan Housel is a partner at the Collaborative Fund and a former columnist at the Wall Street Journal and the Motley Fool. He's not a hedge fund manager. He's not a billionaire. He's a writer and thinker, which is exactly what makes this book so rare and so powerful. Housel has spent years studying how people actually behave around money, not just how financial textbooks say they should behave. He writes in a style that's unusually honest. No jargon, no ego, no complicated formulas. He's been described as one of the best financial writers of his generation. And after reading this book, it's easy to see why. The Psychology of Money was published in 2020 and quickly became a global bestseller, translated into dozens of languages and recommended by investors, CEOs, and ordinary people alike. Housel's core belief? That understanding human nature is more valuable than understanding finance. And this book is his attempt to prove it. Chapter 1: No One's Crazy. The big idea, your financial behavior makes perfect sense to you. Let me tell you about two people. A person who grew up during the Great Depression and a millennial who grew up in the 1990s tech boom. The Depression-era person hoards cash. They distrust banks. They never invest in stocks. Their neighbors think they're irrational. The millennial pours money into tech stocks. They believe markets always recover. They take risks their grandparents would consider insane. Are either of them crazy? They're just products of their experience. This is the foundational idea of the entire book. Every financial decision a person makes is shaped by their unique personal history, by what they've seen, what they've lived through, what they've been taught. Housel points out something fascinating. Two people can look at the same data about the stock market and come to completely opposite conclusions, and both conclusions are perfectly rational given their personal experiences. Someone who watched their parents lose everything in 2008 will look at the market very differently from someone who got rich in it. Here's why this matters. When you judge someone's financial decisions without knowing their full story, you're applying your experience to their life. That's not just unfair, it's useless. Your personal experiences with money make up maybe 0.000000001% of what's happened in the world, but maybe 80% of how you think the world works. So the first lesson is this. Before you judge someone for their money behavior, or before you judge yourself, understand that no one is crazy. We're all just products of the world we grew up in. And that means financial education isn't just about teaching formulas. It's about understanding that humans are not spreadsheets. We are emotional creatures, making emotional decisions, even when we think we're being logical. Chapter 2: Luck and Risk. The big idea: success and failure are rarely 100% deserved. Let me tell you about two teenagers who went to the same school in Seattle in the 1960s. One of them was named Bill Gates. The other was named Ken Evans. Both were brilliant. Both were passionate about computers. Both had the potential to change the world. But only Bill Gates became Bill Gates. Bill Gates attended Lakeside School, one of the only high schools in the entire world in 1968 that had a computer terminal. He won what Housel calls the ovarian lottery. He was born at the right time, in the right place, to the right family. Ken Evans? He died in a mountaineering accident before he ever got the chance to realize his potential. Same school, same talent, different luck, different risk. Here's what Housel wants you to understand. Luck and risk are siblings. They are two sides of the same coin. And the problem with both is that they look a lot like skill when things go well, and a lot like personal failure when they don't. When we hear about a billionaire, our brain immediately looks for what they did to become rich. We assume their wealth is entirely a product of their genius and hard work. We rarely ask, what role did luck play? What advantages did they have that others didn't? And when we hear about someone who lost everything, our brain immediately looks for what they did wrong. We assume it was their fault. We rarely ask, what risks did they face that were outside their control? Nothing is as good or as bad as it seems. This isn't a call for pessimism or victim mentality. Hard work does matter. Skill does matter. But it operates within a framework of luck and risk that we often pretend doesn't exist. So what should we do with this insight? Two things. First, be careful who you worship. Be careful who you copy. When you look at a wildly successful person, ask yourself, how much of this was replicable skill versus unreplicable luck? Second, be kind to yourself and others when things go wrong. Risk is real. Bad outcomes can happen to good, careful people. The goal isn't to avoid all risk, it's to ensure that, when bad luck strikes, it doesn't destroy you completely. That concept, avoiding complete destruction, becomes one of the most important threads running through this entire book. Chapter 3: Never Enough the Big. Idea: the most dangerous financial disease is goalpost moving. In 2004, Rajat Gupta was one of the most respected men on Wall Street. He had been the CEO of McKinsey. He sat on the boards of Goldman Sachs and Procter & Gamble. He had a net worth of hundreds of millions of dollars. And yet, he risked all of it for a few extra $1 million. He passed insider trading information to a hedge fund manager. He was caught. He went to prison. Why would someone worth hundreds of millions risk everything for a little more? Because he was comparing himself to his billionaire friends. And next to a billionaire, even 100 million feels like not enough. This is the trap Housel calls never enough. And it's one of the most destructive forces in financial life. Here's how it works. You set a goal. You achieve the goal. And instead of feeling satisfied, you immediately raise the bar. You were happy wanting $100,000. Now you have it and you want $1 million. You get that and you want $10 million. The goalpost keeps moving. And the more the goalpost moves, the more risk you're willing to take to chase it. Until, like Rajat Gupta, you risk something that is genuinely priceless, your reputation, your freedom, your relationships, for something you don't actually need. The hardest financial skill is getting the goalpost to stop moving. Housel also tells the story of Herb and Dorothy Vogel, a postal worker and a librarian who lived on one salary, saved the other, and quietly bought art for decades. By the time they died, they had amassed a collection worth $140 million, which they donated entirely to public museums across America. They knew what enough looked like, and that knowledge made them, in the truest sense, wealthy. So here's your homework from this chapter. Define enough for yourself. Not what society tells you should be enough. Not what your rich neighbors have. What actually, genuinely, is enough for a life that feels meaningful and free to you. Because the person who knows what enough looks like will always outperform the person who doesn't, no matter what the stock market does. Chapter 4: Confounding Compounding. The big idea, the eighth wonder of the world, and why we ignore it. Here's a question for you. Warren Buffett has a net worth of approximately $80 billion. What percentage of that wealth do you think he earned after the age of 65? The answer? Over 95%. Buffett started investing at age 11. But because he started so young and never stopped, the last few decades of compounding created almost all of his wealth. His skill is investing, but his secret is time. Now here's a thought experiment Housel poses. What if Buffett had started investing at age 30 instead of 11, and stopped at age 60 to retire like a normal person? With the same investment returns? His net worth would be about $11.9 million. Not $80 billion. $11.9 million. The difference between $11.9 million and $80 billion isn't skill. It's time. It's decades of uninterrupted compounding. This is why compounding is so counterintuitive and so profound. Our brains are wired to think linearly. We assume that 10 years of returns gives you twice as much as 5 years of returns. But compounding doesn't work linearly. It works exponentially. Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with for the longest period of time. There's another story Housel tells. Jim Simons, founder of Renaissance Technologies, has the best investment track record in history, 66% annual returns over decades. Yet his net worth is only $21 billion, far less than Buffett's. But because Simons didn't start until his 50s. Even 66% returns can't beat 20% returns over 70 years of compounding. The lesson? The greatest enemy of compounding is interruption. Pulling money out. Panic selling. Switching strategies. Every time you interrupt the process, you reset the timer. And you lose not just the returns you missed, you lose all the future compounding those returns would have generated. So what's the most powerful financial move you can make? Start early. Stay consistent. Don't interrupt the process. Even mediocre returns, sustained over a long enough period, produce extraordinary results. The eighth wonder of the world is not a building. It's not a piece of technology. It's compound interest, and your job is simply to get out of its way. Chapter 5: Getting Wealthy versus Staying Wealthy. The big idea: the skills that get you rich are different from the skills that keep you rich. Jesse Livermore was one of the greatest traders in American history. In 1929, he shorted the market and made $100 million in a single day, equivalent to over $1 billion today. He had cracked the code. He understood markets better than almost anyone alive. In 1940, he shot himself in a hotel bathroom, nearly broke. Abraham Germansky was a millionaire real estate developer in the roaring 1920s. He made bold, aggressive bets, and they worked. He had gotten wealthy. By 1929, he was missing. Presumed ruined. Presumed dead. These aren't just sad stories. They're cautionary tales about a distinction that Housel considers one of the most important in all of personal finance. Getting wealthy and staying wealthy require different skills, and actually almost opposite mindsets. To get wealthy, you often need optimism, boldness, a willingness to take risk, a belief in your own vision against conventional wisdom. To stay wealthy, you need humility, frugality, a fear of ruin, the ability to accept that some of your past success was luck, and that luck doesn't last forever. The ability to stick around for a long time without wiping out or being forced to give up is what makes the biggest difference. This should be the cornerstone of your strategy, whatever it is. Housel calls this survival. and he argues it is the single most important financial skill. He uses the example of Michael Moritz, the legendary venture capitalist, who has produced extraordinary returns for 40+ years. When asked how he did it, Moritz said simply, "We've always been terrified of going out of business. Paranoia, not brilliance, was the secret. A deep-seated fear of ruin kept them humble, kept them cautious, kept them alive when others crashed and burned." The practical takeaway here is huge. Your investment strategy doesn't need to be perfect. It doesn't need to produce the maximum possible return. It needs to be one you can survive, emotionally and financially, through markets crashes, recessions, panics, and periods of years where nothing seems to work. The best plan is the one you can actually stick to. Chapter 6. Tails You Win. The big idea. A small number of events drive almost everything. Did you know that almost all of the stock market's gains throughout history come from a tiny fraction of trading days? If you remove the 40 best trading days from the last 50 years, out of roughly 12,500 days, your returns would collapse catastrophically. 40 days. Out of 12,500. That's 0.3%. This is the power of tail events. And it's one of the most mind-bending insights in the entire book. Tail event is a statistical term for something that happens rarely but has an enormous impact when it does. In finance, the market's best days and worst days are tail events. In business, the product that makes a company is almost always a tail event. Housel talks about venture capital. The best VC firms in the world have investment portfolios where the majority of their companies fail. Some return nothing. Some return modest amounts. But one or two, maybe one out of every 100, returns 100x or 1000x and makes up for everything else. Peter Lynch, the legendary Fidelity fund manager, once said that if you're right 6 out of 10 times in investing, you'll have an extraordinary career. He wasn't saying you need to be right most of the time. He was saying you can be wrong most of the time and still win, as long as your winners win big enough. You can be wrong half the time and still make a fortune. What does this mean practically? First, don't panic sell after bad days. The best days often come clustered with the worst days. The investors who fled the market in March 2020 missed the fastest recovery in stock market history. Second, diversify, because you don't know in advance which of your investments will be the tail. The goal is to own enough of the field that when a tail event hits, you're holding it. Third, have patience for many small failures, because they are the price you pay for the occasional spectacular win. Chapter 7. Freedom. The big idea, the highest dividend money pays, is control over your time. What is the highest form of wealth? The big house? A fast car? A prestigious title? According to Housel, and backed by serious psychological research, the greatest thing money can buy is something far simpler: control over your own time. The ability to wake up every morning and decide how you want to spend your day. To work on what you want, with who you want, for as long as you want. To say no to things that drain you and yes to things that energize you. Housel cites researcher Angus Campbell, who studied happiness across America and found that the single most consistent predictor of well-being wasn't income or health or relationships. It was autonomy, a sense of control over one's own life. And here's the painful irony. Many people chase wealth precisely so they can achieve that freedom, but in chasing it, they sacrifice the very thing they're chasing. They work 80-hour weeks. They sacrifice weekends. They miss birthdays and dinners and slow Sunday mornings. They tell themselves it's temporary, just a few more years. But the goalpost keeps moving, and the freedom they're working toward keeps retreating. Using your money to buy time and options has a lifestyle benefit few luxury goods can compete with. The people who Housel describes as truly wealthy are often not the richest people on paper. They're the people who have arranged their financial lives so that they have options. They're not trapped by debt. They're not dependent on a single income stream. They can afford to take a step back. They can afford to say no. True wealth is a calendar you control. Chapter 8, Man in the Car Paradox. The big idea: nobody is thinking about you the way you think they are. Here's something that will change how you think about spending money to impress people. When you see someone driving a beautiful luxury car, what do you think about? The CAR? Or the person driving it? Housel makes a fascinating observation. When we see a nice car, we admire the car. We don't typically think, wow, that driver must be amazing. We think, wow, that's a nice car. So the person who bought that car to signal wealth and success to the world isn't receiving the signal they intended. The world is admiring the object, not them. Housel puts it perfectly: people don't admire you because of your possessions. They admire the idea of themselves owning those possessions. We buy things we don't need with money. We don't have to impress people we don't like. This is one of the greatest financial traps humans fall into: status signaling. Spending money not because things genuinely improve our lives, but because of how we imagine will be perceived. And the cruel punchline? Even if people do admire your car, your house, your watch, that admiration doesn't transfer to you. It stays with the object. You gain nothing from it except a lighter bank account. The practical lesson: before any major purchase, ask yourself, who are you actually buying this for? If the honest answer is, for other people to notice, you might want to reconsider. Chapter 9. Wealth is what you don't see. The big idea: true wealth is hidden. Riches are visible. We have a fundamental misunderstanding of what wealth actually is. When we think of a wealthy person, we typically imagine someone with a nice house, an expensive car, designer clothes, first-class flights. But Housel draws a powerful distinction between wealth and riches, and once you see it, you can't unsee it. Riches are what you spend. Wealth is what you don't spend. The expensive car you see driving down the street? That's not evidence of wealth. It's evidence of spending. The person driving it might have a negative net worth. They might be leveraged to the hilt. They might be one bad month away from financial disaster. Real wealth, actual financial wealth, is invisible. It's the investments you haven't cashed in, the savings you haven't spent, the options you've kept open by not splurging. Housel uses a great analogy. Wealth is the cars not purchased, the diamonds not bought, the first-class upgrade declined. It's the financial assets that haven't yet been converted into the stuff you can see. Wealth is an option not yet taken to buy something later. Its value lies in providing options, flexibility, and growth. This reframe is incredibly important for how you look at your own financial life. Every dollar you save and invest isn't money you lost by not spending it. It's future freedom. It's future options. It's the ability to handle an emergency, take a career risk, or retire early. Stop trying to look wealthy. Start trying to be wealthy. The second one is built in silence, through discipline no one can see, which is exactly why so few people do it. Chapter 10. Save money. The big idea: the only savings rate that matters is the gap between your income and your ego. Here's a financial insight that most people never hear. You don't need a high income to build wealth. You need a high savings rate. And your savings rate is determined not by what you earn, but by the gap between what you earn and what you spend. The problem is that most people's spending rises to meet their income. Get a raise? Upgrade the apartment. Get a bonus? Buy a better car. This is called lifestyle creep, and it's the silent killer of wealth building. Housel points out something counterintuitive. Past a certain level of income, building wealth has nothing to do with your investment returns and everything to do with your savings rate. A person with a modest income but a 30% savings rate will build more wealth than a high-income earner with a 5% savings rate. Every single time. And here's the most important insight. You don't have to want more in order to earn more and save more. You can simply want less. The most powerful way to increase your savings isn't to raise your income. It's to raise your humility. Wealth building is not complicated. Spend less than you earn. Invest the difference. repeat for decades. The math is simple. The psychology is not. But if you can master the psychology, if you can resist the constant pressure to inflate your lifestyle every time your income rises, you will build wealth that most high earners never achieve. Chapter 11. Reasonable, rational. The big idea. Aim for reasonable decisions you can live with, not perfect ones. Here's a question. Should you invest entirely for maximum returns, regardless of how terrifying it feels? The purely rational financial answer is yes. Maximize returns. Ignore emotions. Follow the math. But Housel argues this is actually terrible advice. Because you are not a spreadsheet. You are a human being. And a strategy that maximizes mathematical returns but causes you to panic and sell at the worst moment is worse than a slightly less optimal strategy that you can actually stick to. He tells a personal story. Housel keeps a larger cash buffer than any financial advisor would recommend. From a purely rational standpoint, that cash is lazy money. It should be invested. But that cash buffer helps him sleep at night. It gives him peace of mind during market crashes. And because of it, he's never panic sold his investments. Over time, that psychological benefit more than compensates for the cost of holding cash. Aim to be reasonable rather than strictly rational. Reasonable is more realistic and you have a better chance of sticking with it for the long run. The best financial strategy isn't the most mathematically optimal one. It's the one that fits your personality, your life, your sleep quality. It's the one you can actually execute, calmly, consistently over many decades. This is why financial advice is so personal. A high-volatility portfolio might be rational for a 30-year-old. But if that person loses sleep over every market dip and sells at every correction, they'd have been better off with a less optimal but more sustainable approach. Chapter 12. Surprise. History is misleading. The big idea. The world changes. Don't over-index on the past. Here's a trap that catches even experienced investors, studying financial history to predict the future. It sounds reasonable. Learn from what happened. Prepare for what might happen again. But Housel warns about a subtle danger. History is mostly the study of events that are no longer relevant. The world of 1930s finance is structurally different from the world of 2020s finance. We have different institutions, different regulations, different technology, different demographics, different global interconnections. The tail risks that destroyed people in 1929 are not the same tail risks we face today. More importantly, the biggest market crashes in history were almost always caused by events that nobody had predicted, events that had no historical precedent. 9/11, the 2008 mortgage crisis, COVID-19. History gives us confidence. Outlier events crush that confidence. The most important events in economics are the big surprises, the things no one saw coming. And by definition, you can't prepare for something you haven't imagined. The right response is not to ignore history. It's to respect the fact that the future will always contain surprises that history didn't prepare you for. The solution? Build your financial life to be resilient to surprises, not just robust against past shocks. This means maintain buffers. Avoid leverage. Don't bet everything on a single outcome. Assume that something unexpected will happen. You just don't know when or what. Chapter 13. Room for error. The big idea. The most important part of every plan is planning for the plan to go wrong. Benjamin Graham, the father of value investing and Warren Buffett's mentor, had one concept at the core of his entire investment philosophy: the margin of safety. Buy a stock worth $100 for $70. That $30 gap is your buffer, your room for error, the protection against being catastrophically wrong. Housel expands this concept beyond investing into all of personal finance, and argues it may be the single most important financial principle there is. But because our forecasts are almost always wrong. Not a little wrong. Often dramatically wrong. Think about the last time you made a financial projection. I'll have $X saved by this date. This investment will return Y%. My income will grow at this rate. How often did things play out exactly as planned? Almost never. Life is too messy, too random, too full of surprises for any projection to be reliably accurate. The purpose of the margin of safety is to render the forecast unnecessary. In practical terms, keep more emergency savings than you think you need. Take on less leverage than you could technically handle. Plan for income disruptions even when everything seems stable. Assume your car will break down, your roof will leak, your job will change. This isn't pessimism. It's wisdom. It's the recognition that the real world is messier than any plan, and that the people who survive and thrive financially are not the ones who made the best predictions, but the ones who built the most resilience. Chapter 14, You'll Change. The big idea: your future self has different goals than your current self. Research shows that humans consistently overestimate how much they'll stay the same over the next decade, while simultaneously recognizing how much they've changed over the last decade. Psychologists call this the end of history illusion. We see ourselves as finished products, as if we have reached the final version of who we are. But we are always works in progress. Why does this matter for money? Because you might be making long-term financial decisions based on who you are today, not who you'll be in 20 years. The career you're passionate about at 25 might feel like a trap at 40. The city you love at 30 might feel wrong at 50. The lifestyle you're optimizing for today might not match the life you actually want later. Housel talks about people who lock themselves into extreme long-term financial plans, saving aggressively for a specific retirement vision, only to find that when they get there, they want something completely different. And now they've sacrificed years of potential enjoyment for a future self they no longer recognize. We should avoid the extreme ends of financial planning. Assuming you'll be happy with a very frugal life or a very lavish one are both risky. Aim for balance. The financial advice here: build flexibility into your plan. Don't over-optimize for a specific future outcome. Leave room to evolve. The goal isn't to build the perfectly efficient financial machine, it's to build one resilient enough to accommodate who you might become. Chapter 15, Nothing is free. The big idea: market volatility is the price of admission, not a fine. Imagine you want to visit Disneyland. You look at the ticket price, $120. That feels expensive, but you pay it because you've decided the experience is worth the price. Now imagine a different approach. You sneak in without paying. You get caught. You're thrown out. You feel terrible. And you didn't even get to enjoy the park. This is a perfect metaphor for how most investors relate to market volatility. Market volatility, the stomach-dropping feeling when your portfolio falls 30%, is the price of admission to long-term investing returns. It's not a punishment. It's not a sign that something has gone wrong. It's the ticket price. But many investors treat volatility like a fine, like something that shouldn't be happening and needs to be avoided at all costs. So they try to sneak in to market returns without paying the price. They time the market, they hide in cash, they sell when things get scary. And inevitably, they get thrown out. They miss the recovery. They lose the returns they were trying to protect. The volatility/uncertainty fee is the price of admission to the greatest wealth creation machine in history. The fee is worth it, but you must accept that it exists. The mental reframe is powerful. The next time your portfolio drops 20%, instead of panicking, try to think, I'm paying the price of admission. This is normal. This is temporary. And the long-term return more than compensates for it. Investors who can genuinely internalize this will dramatically outperform those who can't, regardless of which stocks they pick. Chapter 16, You and Me. The big idea: we're all playing different financial games with different rules. In 2008, a serious, thoughtful financial analyst concluded that housing prices would never significantly decline. He presented detailed historical data to prove his case. He was ridiculed when the housing market collapsed. But here's what Housel points out: that analyst wasn't stupid. He was just playing a different game. His entire model was built around data from the long-term institutional real estate market. His time horizon was 30+ years. And over very long time horizons, prices do tend to recover and rise. But short-term traders, people operating on 2 to 5 year time horizons, were playing an entirely different game with entirely different rules. When you and I look at the same market, the same stock, the same investment, we may be making completely rational decisions that are exactly opposite to each other. Not because one of us is right and one is wrong, but because we have different time horizons, different risk tolerances, different goals, different financial situations. Prices are determined by the market, which includes every kind of investor, from day traders to 30-year holders. Beware when their behavior influences your own. The most dangerous financial mistake you can make is copying someone else's investment strategy without understanding what game they're playing. Before you make any financial decision, ask, what is my time horizon? What are my actual goals? And is this strategy designed for someone in my situation or someone completely different? Chapter 17: The Seduction of Pessimism. The big idea: pessimism sounds smart. Optimism is the bigger bet. Quick question: who sounds smarter to you? Person A: the market will be broadly higher in 20 years, driven by technological innovation and human ingenuity. Person B: the market is overvalued. Debt levels are unsustainable. There are 15 specific reasons we're heading for a catastrophic crash in the next 18 months. If you're like most people, Person B sounds smarter, more specific, more sophisticated, more aware. But Housel argues this is an illusion. Pessimism is seductive because it sounds like deeper thinking. Optimism sounds naive. But historically, financially, the optimists have been right far more often than the pessimists. Think about it. If you had invested in the US stock market in 1900 and held, you'd have survived 2 world wars, the Great Depression, the Cold War, 9/11, the 2008 financial crisis, a global pandemic, and ended up with one of the greatest wealth-building machines in history. The doom and gloom predictors had compelling, intelligent arguments at every stage. And they were wrong every single time about the long-term outcome. Pessimism is seductive and feels like intellectualism. But in the long run, it has a worse track record than optimism about human progress. This doesn't mean ignoring real risks. Short-term risks are real and can be devastating. But for long-term financial planning, if you're betting on what the world will look like in 30 years, the smarter bet, historically, is on human ingenuity, adaptation, and growth. Chapter 18: When You'll Believe Anything. The big idea: stories are more powerful than statistics, and that's dangerous. In 2008, the US housing market was crashing. Trillions of dollars in value were being wiped out. Millions of people were losing their homes. Why did so many smart people, including bankers and economists and regulators, not see it coming? Because they were in the grip of a very powerful story that home prices always go up, that America's demographics guaranteed perpetual demand, that financial engineering had finally cracked the code on risk. That story was seductive. It was optimistic. It confirmed what people wanted to believe. And it was completely wrong. Housel's insight: people don't think in statistics. They think in stories. And the stories we believe about the economy, about our investments, about our financial future, shape our decisions far more than any spreadsheet. The danger is that we often adopt stories not because they're true, but because they're comforting. Because they tell us what we want to hear. Because they're told by people we admire or trust. The more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. The antidote isn't to stop using stories. Stories are how humans make sense of complex realities. The antidote is intellectual humility. It's regularly asking yourself, what would have to be true for me to be wrong about this? It's seeking out data and perspectives that challenge your current narrative. Because the most expensive beliefs in financial history have been the ones everyone agreed with. Chapter 19. All Together Now, Housel's Personal Strategy. The big idea, putting it all into practice. At the end of the book, Housel does something rare. He tells you exactly what he does with his own money. Not as advice, but as transparency. As an example of someone who has actually internalized these principles and applied them to real life. Here's what he shares. Number 1. He keeps a large cash buffer. More than financial advisors recommend. Not because it's mathematically optimal, but because it helps him sleep at night and prevents panic decisions during market crashes. Number 2. He and his wife set their lifestyle expectations very early in their relationship and have largely kept them there, even as their income grew. They drive normal cars. They live in a normal house. The gap between what they earn and what they spend is large, and that gap goes straight into investments. Number 3. He invests in low-cost index funds. Not because it's the best possible strategy, but because it's a very good strategy that he can execute consistently without anxiety for the rest of his life. Number 4. He doesn't check his portfolio obsessively. He set his strategy, and he largely ignores the day-to-day noise. Number 5. He thinks about investing as buying a share of humanity's future productivity, not as gambling on stock prices. That long-term framework keeps him calm during volatility. I have no idea what the market will do next year, but I'm highly confident that in 30 years, the world will produce more than it does today, and owning a piece of that seems like a reasonable bet. None of these tactics are revolutionary. None of them require genius. What they require is consistency, humility, and a long enough time horizon, which, as this whole book has been arguing, is harder than it sounds, and more powerful than you'd imagine. Here are some key takeaways, the lessons that will change your relationship with money. No one is crazy. Financial behavior is shaped by personal experience, not just logic. Luck and risk are real. Success is partly earned, partly given. Stay humble. Defined enough. The goalpost that keeps moving is the greatest financial trap. Compounding is time-dependent. Start early. Never interrupt it. Getting wealthy and staying wealthy require opposite mindsets. Build for survival. Tail events drive most outcomes. A few big wins compensate for many small losses. Freedom is the greatest return. Optimize for control over your time. Wealth is invisible. True wealth is the spending you didn't do. Save ruthlessly. The savings rate, not returns, determines wealth. Be reasonable, not purely rational. Pick a strategy you can emotionally sustain. Build room for error. Every plan should plan for the plan to fail. Volatility is the price of admission, not a fine. Pay it willingly. Long-term optimism beats short-term pessimism, historically and consistently. Your story shapes your decisions. Question the narratives you tell yourself. And here is the final conclusion, the most important sentence in the book. We've covered a lot of ground today. Luck and risk, compounding, the seduction of pessimism, tail events, freedom, enough. But if you take only one thing from this entire video, one sentence that captures the soul of the psychology of money, let it be this. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. That's it. That's the whole book. You don't need to be a genius. You don't need a finance degree. You don't need a Bloomberg terminal or a hedge fund connection. You need to behave. You need to be patient. You need to stay humble. You need to keep going when it's scary and resist when it's exciting. You need to know what enough looks like. You need to value your time over your image. You need to survive long enough to let compounding work. These aren't financial skills. They're human skills, character skills, and that means they're available to everyone. regardless of income, regardless of background, regardless of intelligence. The most powerful investment tool in the world isn't a trading algorithm or a hedge fund strategy. It's you, at your best, at your most patient, at your most disciplined. If this video added value to your life, if even one of these ideas shifts the way you think about money, then please leave a comment below with the insight that hit you hardest. It's one of the most readable, most human, most genuinely useful books about money ever written. I promise you, it's worth every page. Until next time, stay patient, stay humble, and build for the long game.